Hello everyone and welcome to your Glassnode video report for week 32, 2022. Now, as the derivatives markets start to evolve and mature and become deeper in their liquidity, what we see is that there are more sophisticated traders with larger capital, really the institutional side entering this space. Now, the Ethereum Merge is a very interesting event because it's upcoming, it's coming up in September, and therefore we can see how the market using derivatives is actually pricing this particular event. We can compare it to Bitcoin, which doesn't really have anything coming up, so that's kind of our baseline. And really what we're trying to assess here is whether the Ethereum Merge is going to be set up as a sell the news event, or at the very least, how are traders in these derivative markets positioning themselves for it? So as I mentioned, these markets are starting to really develop. Derivatives, both futures and options, allow institutions and sophisticated traders to put on increasingly complex, increasingly advanced, but also risk hedged positions. So what we're looking for is where is the demand, where are people buying, and at what type of contract? Are we talking about September, October? Whereabouts on the overall curve are we actually seeing the demand and the sell side activity going on for these contracts? So it's a very, very interesting study. As I mentioned, Bitcoin doesn't have a merge coming up. It's essentially going to be the same Bitcoin in September as it is today. So therefore, we can really use that as the baseline. How is the market pricing the digital asset space with Bitcoin as that centerpiece? What we then start to look at is the divergence between Ethereum and Bitcoin open interest in the options market, which is where things get really interesting. And we're going to start looking at how we have very, very heavy call option buying going on within the ETH space. And we'll look at some of these metrics that help us actually explore this detail. And then we're going to look at the overall ETH spot performance and the futures pricing to actually discover something even more interesting, which is what's going on in the options market is quite different to what's going on in the futures and the spot market. So we can actually see that even within the Ethereum space, there's a little bit of a divergence between these behaviors and what that tells us about market positioning. So hopefully you learn a little bit more about derivatives during this session. What we're seeing is a very, very big picture trade. There's lots of individual actors all doing different things, but what we're looking for is the aggregate behavior and how these markets, as they become increasingly mature, increasingly deep with liquidity, how they can tell us even more information about what's going on within the space. So here we are in our week 32 dashboard, and we're going to start by building up this Bitcoin baseline. Bitcoin doesn't have any particular changes on a fundamental level coming over the next couple of months. So therefore, what we're looking at here is just the aggregate sentiment and how the market is currently pricing the digital asset space. So we're purely looking at a supply and demand relationship and what the market thinks looking forward. Now we're going to start by looking at futures open interest, and this includes both calendar expiring and perpetual swap markets. So it's all in how much leverage is in the system of futures markets. Now, what we're looking at here is the open interest in a BTC denomination. And the reason that I do this is it removes the influence of coin price. We'll explore this in a moment. But the first thing I want you to note is that what we really have is this kind of generally sideways between about 400 and about 300,000 BTC in terms of overall open interest. We can see that it goes through periods of relatively high, which then is followed by a deleveraging event quite often, particularly in the bull phase. And we see it typically climbs and then descends as a deleveraging takes place. But note here, as we come into April 2021, that we had a significant expansion. This got up to an all-time high of about 540,000 BTC, so a significant deviation well and truly above the typical norms. So we can see that there is quite a bit of leverage that has crept into the system. However, let's go back to that USD denomination. I'm going to convert this over to a USD basis. Now, note that the coin price is down at about 24,000 at the time of recording. So note how in the background we can see coin price and open interest typically move somewhat in tandem. This is essentially the influence of coin price and the reason why I actually showed it in BTC denomination first. Note down here on this right-hand side that we actually have more open interest than price. It's essentially accelerating at a faster rate than the price is. That's essentially what we were seeing before. There is more leverage creeping into the system. As a result, even though coin price is lower, we're seeing more leverage coming in on a relative scale. The amount of open interest is larger relative to the Bitcoin market size. Now, we're going to explore that in a bit of detail, what I actually think that means as we go through this section. Now, when we look at the futures trading volume, You can clearly see the expansion of futures. We saw them through the 2021 phase till about May, more or less traded somewhat sideways. We're talking about, here's $80 billion. So we're talking about significant daily trade volume on a 7-day moving average basis. We had that sell-off in May, which really started that bear market. We've talked about this over previous videos, and note that there was a progressive decline. Futures volume slowed until we got to around April, which is coincident with where we saw the open interest start to really climb. And it's more or less plateaued since that point. We can see the spike here during the lunar collapse, and then again on the 18th of June as we sold down below the 20,000 all-time high from 2017. But note how we've more or less stabilized. Trading volume seems to be reaching some kind of a plateau. So what we're really seeing here is, yes, we're seeing more leverage coming into the system, and we'll explore whether it's excess or not in a moment. But what this is really telling me is that we're getting a bit of a stabilization. The market's kind of reaching a bit of equilibrium down here in the 20,000s, and it's certainly not declining the way it has been for really the last 18 months. So we're starting to see a little bit of a transition potentially. Maybe there's a bit more desire for these institutions and traders of these futures markets to be starting to take on some price exposure. It doesn't look like they're betting the farm just yet, but it does look like they're starting to be willing to take on a little bit more price exposure, and thus we're seeing that uptrend in our overall open interest. Now, in terms of the character of that leverage, what this chart is showing is the percent of the margin. So when you open up a futures contract, you need to have collateral against which you're essentially borrowing in order to put the position on. Now, there's two types of collateral. They can either be crypto-based, meaning you're using Bitcoin to buy leverage with Bitcoin, or conversely, you can have stable coins or fiat. Now, naturally, when you have a large proportion, what we had over here in April in 2021, over 70% of the margin was coin margin. So that means that when the price fell here in in May 2021, not only did the futures contract fall in value, but the collateral that was backing it also fell in value. So you have this negative, almost a double, it's called negative convexity. Both the collateral and the futures are falling at the same time, which leads to a massive deleveraging. Now, since that time, there's been a lot of structural shifts. We've seen that overall leverage has been more regulated in certain parts of the world. We've seen different rules and jurisdictions changing the way that they deal with leverage at a retail level. And over time, this massive downtrend has started to stabilize around 40% being crypto margin. Now, the flip side of that means that 60% of the backing of all these futures contracts now is stablecoin or fiat, which is a much more predictable curve and doesn't have that double negative convexity going on of the collateral and the futures falling at the same time. So yes, whilst we have more leverage in the system on a relative scale size at the moment, trading volume seems to be normalizing, and we're also in this regime of somewhere around 60% of the collateral being stablecoin. So it's a much, much healthier form of leverage. It's not the same kind of speculative Bitcoin betting on Bitcoin that we had back here in April 2021. It's a lot more stable, and thus we should be expecting somewhat less volatility driven by those events. Doesn't mean it can't still happen, but it is a healthier form of leverage. So now we're going to start getting into a little bit more technical details regarding futures markets. Now, the chart that I've got plotted out here is called the term structure. So on the x-axis, we have dates, and on the y-axis, we have the Bitcoin price as mapped out in Bitcoin calendar futures. So these are futures that actually have a set expiring date. We have them out in September, October, at the end of the year, October, and then all the way out to December, January. And then it actually continues into 2023. So the way to look at this chart, note how it's in an upward slope. This is called contango. And it basically means that the market is pricing Bitcoin at a higher price in the future. It costs you a premium to take on Bitcoin exposure in the future. Now, we're not talking about a very, very large premium here. We're down here about 24,000 or 23,800 at the front end of the curve. And if we go out to the end of the year, we're talking about 24,200. So the spread between these is about $400. It's not a huge amount. It's a couple of percentage points, but it is, what's more important to take away here is the shape of this curve. This essentially means that it costs you a little bit of a premium to go long Bitcoin in the future. Take that concept away, and we will revisit this idea later on as we get down to the Ethereum side. And then we also have the perpetual funding rate. So for those of you who aren't aware, in perpetual swap markets, the way that the overall futures track the index price or the spot price is that if there's too many people bidding on that contract, such as we had in the bull market, these green zones, the people who are long must pay an interest rate to those who are short. So the idea is that when people are too leveraged on the long side, there's an increasingly large incentive. Over here is about 100% a year, very, very large incentive for market makers to go short and take the other side of that trade. Now, conversely, during major sell-offs, here's March 2020, you have the opposite. People are wanting to go short. They're forced out of their positions by selling. So the futures price trades well below the spot price, and thus people are incentivized by getting an interest rate to go long. So that's how futures funding rate actually works. Now I'm just going to zoom in a little bit more. Note in our current regime, we are slightly positive. Now, you may have seen in the past that these periods of very high positivity means people are willing to pay an interest rate to go long, and it can precede some kind of a flush out. So we are positive, but also note, this is only yielding about 3 and a bit percent. It's actually not too dissimilar to what you can get from a US Treasury yield. So somebody who's doing a cash and carry trade, in many ways, it's almost better to just buy a treasury. So it's not really symbolizing a huge amount of leverage. So there's not a whole lot of people betting the farm going very long. We can see that our futures volume is stabilized. We can see that open interest is climbing. Overall, the general takeaway of this is it looks like people are willing to take some price exposure down here in the 20,000s, but they're not all in. It just looks like a growing interest of starting to move back into the market. But right now, it doesn't look like an extraordinary amount of leverage like we saw in the early phase of this bull. It really just looks like people are dipping their toe. The market is just starting to get a bit of price exposure, but is certainly not looking like it's fully invested. So it's kind of early signs of stabilization. But this is really our baseline. This is what the market is kind of seeing for the digital asset space. It's constructive, but it's not betting on an all-time high tomorrow. It's a little bit cautious. It's just dipping a toe. So now we're going to take that baseline and we're then going to explore what it looks like on the Ethereum side with the merge coming up, and you'll see just how significant this divergence really is. So the first piece of evidence that there's something going different between the Ethereum space and the Bitcoin space is options open interest. So what we're looking at here on the red curve is Bitcoin open interest. Note that it's been higher than Ethereum open interest for the entirety of this data set, essentially since options have been trading, until the last couple of weeks, where Ethereum in blue has seen an enormous jump higher. It's currently got about $6.6 billion worth of open interest, whereas Bitcoin's got about 4.8. And note that Bitcoin hasn't really seen a big uptick. Now, the other thing to note is that Bitcoin open interest is quite low relative to previous history. Much like futures open interest, it's there, but it's not really anything significant. Nowhere near all-time high. Here's Ethereum open interest, and note that it's pretty much at the, not quite there, but very close to an all-time high in open interest, but specifically for options. So now we're going to scroll down and think, okay, what is coming up for Ethereum that would make people want to be buying options? Now remember, the difference between options and a futures contract is options, the best way to think about them, they're an insurance contract. When you're buying a call option, you're essentially betting that the price will be higher in the future, and somebody who's selling that option to you is taking the other side of that trade. Essentially, they are the insurer, the seller. On the other side, if you're buying a put option, you're buying downside protection. And that person, the person who's selling you that option is taking the other side of that trade. They are insuring you. They take a premium and then they insure your position below a certain strike level. So what we're looking at in this chart, the green bars are call option open interest. And on the x-axis, we have our strike price. And in the purple bars, we have put options. And now this is for the September, the 30th of September 2022, and the merge is slated to be around the 19th. So this is basically betting on what the price will be in September with the merge contained within that. So the first thing that you can stand out and see here is note how much call option buying there is. There is an extraordinary amount of demand for speculative positions. Here's our current price at 1,700. Here is the amount of demand betting that the Ethereum price will be higher. Here's 2.2K, 2.8K, 4K, 5K. There's even a couple up here who are betting on 10K ETH over the course of the next month and a bit. So quite significant price appreciation. Again, if you're betting up here at the 10,000 level, that's a very, very out of the money call option. So your premium that you pay for that insurance is much less, but obviously the payout if it happens is much larger. Now note the scale of put options. They're certainly there, but there's nowhere near as many. Now, there's also a concept in options called max pain, and that is the price that, at what price does the Ethereum price need to be trading at on the 30th of September when these contracts expire to have the maximum number of open interest, the maximum number of contracts expire worthless? Because if the price is down here at max pain of 1350, if the price is down here, that means that all of these put options will expire out of the money, and all of these call options, this entire volume of call options, will expire out of the money. So the max pain scenario is actually where the price trades lower between now and the merge, making all of these options contracts expire worthless. Now, again, that doesn't mean that that's what's going to happen. But if in terms of this trade, if we look at this big trade in aggregate, what is the maximum pain scenario for all of these options buyers? It's essentially that price doesn't do very much between now and the merge, and essentially all these options expire worthless. Now, we can also jump into a metric called the implied volatility smile. So I won't do a masterclass on options, but suffice to say there's three things that go into the price of an option. The first one is where the price is relative to the strike. So obviously an option that is in the money, say it's priced at $1,200, if ETH is trading at $1,700, that is in the money. So therefore where is the value of the asset relative to the strike price? That's the first component. The second component is the time element. How much insurance are you buying? It is cheaper to insure your car for 1 month than it is for 1 year. So you pay a time premium depending on how far away the option is. And given these options are in September, the time premium is starting to decay quite significantly. There is the final component, which is the volatility. So in order for ETH to go from where we are right now at 1,700 to 10,000 in a month, we need an enormous amount of volatility. So you must pay a higher premium in order for the price to actually get there. In order for that to make sense, you need to actually see that volatility come in. So what the implied volatility is essentially the premium that people are paying under the belief that that particular price or that strike will happen. So what we have here, again, here's our strike prices down the bottom. These green bars you can see hovered in the background, these translucent green bars, that's the demand side from all of those call options. This is the thing to pay attention to. Note how this smile is much, much higher on the tail end. This is showing that people are willing to pay a higher and higher premium. There is an extreme bullish bias priced into these September options. The most important thing here to observe, these green bars, think about them as demand. People are buying these call options and they're paying a premium for it. That's what the takeaway from this message is. This is September. 1 month after September, the October contract, that whole tail end is gone. There's no demand for call options after the merge. However, look at the left-hand tail. There's a huge amount of demand for put options, downside insurance, selling the news. The options market is expecting a buy the rumor and a sell the news event. They are buying and speculating with call options into the merge, and then they are buying downside protection coming out of the merge. So what this actually looks like is a very big picture, sophisticated trade that there is a lot of demand for call options pre-merge and a lot of demand for put options post-merge, which looks like a buy the rumor, sell the news. Now, again, that doesn't mean that that's what's going to happen, but this is the way that the options market is currently pricing. So this is one scenario, and it's showing you how very sophisticated traders are actually putting on a position where they're speculating into it and then they're hedged on the other side. So very, very interesting dynamics at play, but we can see this because we have access to all of this transparent data. So in the last section, we're going to compare what we just discussed in the option space, and we're going to compare it to spot and futures to just understand what's going on. We'll come back to that term structure chart momentarily that we saw from Bitcoin. So You would think that with so much anticipation and so much momentum behind the merge and $6.6 billion in options open interest, you would expect that there'd be an equivalent amount of demand in spot. So what we have here is the exchange net position change, the monthly net flow in and out of exchanges. Now this one's priced in USD. And what I want you to see is note these very, very large demand nodes. Granted, they were at all-time highs and during the bull market, but also on the way down. But this is showing somewhere over $4.7 billion of outflows. Here, we're looking at $5.9 billion in ETH outflows per month coming out of exchanges. I mean, these are huge numbers. This is 700 million. Note how much smaller this is than what we saw over here. Now, granted, ETH is obviously at a much, much cheaper price. So there's that element to it. So let's be a bit fair. But what we're looking at here is $700 million in ETH outflows, spot, relative to $6.6 billion in overall options contracts. And actually, this particular outflow is about 2% of the size of futures trade volume. During these previous peaks, even when we had $4.6 and $5 billion worth of net outflows, it was about 20% of overall futures volume. Here we're talking about 2%. So the demand for spot is substantially lower than the demand for derivatives. What we're actually seeing here is that this looks like a price exposure trade rather than a fundamental accumulate ETH trade, at least the way that the market is currently presenting it. It's a very interesting dynamic where the spot market is actually a little bit lackluster by comparison to the price speculation that's going on in the futures and options markets. Now, here we are at our futures term structure chart. Now, remember, the shape of the curve for Bitcoin, that upwards trend was more important. People are willing to pay a premium to buy future exposure. Look at the ETH charts, the exact opposite. This is called backwardation. This means that there is a discount. The market is expecting a discounted price for ETH in the future. Or the other way to think about that, the market is selling contracts. They are net short contracts in the future, which is depressing the price of that futures contract. This aligns with what we saw before. The market they are already short. In many ways, they've actually already short and they've actually already sold the news. They've sold the news in the future already. They've hedged their downside risk. And thus what we're actually seeing is that the market has put on a very sophisticated trade across both futures and options, trading these fundamental events like the ETH Merge. So thanks for tuning in, folks. Hopefully you learned something new about derivatives and some of the very, very intricate and dynamic layers to this. Obviously, these things can change and none of this is predicting the future. This is just simply looking at where is the money flowing? How has the market positioned itself? And what is its overall view of the merge? And what it appears to be is that there are very large institutional and sophisticated actors putting on trades, but overall, it seems to be a price exposure element rather than a fundamental element. So there's more demand for the actual futures and derivatives than there is for actually buying the spot at the moment. We will see how this plays out and we will evolve over time. Anyway, thanks for tuning in. Hopefully you enjoyed that session and I'll see you in the next one. Cheers.